Hi, so this is Nooresh Merani again. So we are done with the part why to invest into small caps and when to invest into small caps. Now we go to the next topic, how to invest into small caps. Now this is where we go towards the technical analysis part of it in terms of timing. So that is where we look at two things. First is chart patterns, which is technical analysis chart patterns, and then there is volumes, which is very significant in terms of Indian way of looking at markets. So let us start off with chart patterns first. Now there are various chart patterns which are there in technical analysis. We'll try to cover a few in terms of just understanding the basics of it so that you have a fair idea about what the chart pattern is. So there are multiple chart patterns like cup and handles, then there is, you can look at flags, channels, triangles, etc. Head and shoulders, which is what we'll not be covering. So what we'll be looking at is cup and handles to start with. So what is a cup and handle pattern? Now, when you look at a cup and handle pattern like you see it on the screen, it is basically say a stock falling from say roughly 100 to 120 to say 80 rupees. So it has fallen a good 20-30% out here, then recovers back to that 120 mark, dips back to 100, then again goes back about 120. So basically it is like 120 to 80, back to 120, then to 100, then back to 120. So it's basically three tops at 120, and then when the breakout happens, you call it a cup and handle breakout. Now, when we look at this chart pattern, you have to remember that the cup has to be bigger, the handle has to be smaller, and more importantly, why does this pattern really make an important assumption is the fact that if we look at the chart pattern just without any logic, it could be considered as three tops. But why do we look at cup and handle? So let us try to understand that significance and why it actually works. So if you look at it, the stock has corrected from 120 to 80, come back to 120, and now again dipping to 100 is now breaking out about 120. Now at this point of time when the breakout happens, what are the targets in place? So very simple calculation, the handle size is your first target, which is basically 120 minus 100, so 20 points, 120 minus 80, which will be your cup target, so that is another 40 points. So roughly your target would be 140 and 160. Now this is the chart pattern, this is the implication. Now what is the time frame of generally a cup and handle pattern? So from this first top to the third top, the ideal time frame is more than 3 months. It could be years, it's fine, but it has to be more than 3 months in the minimum case. Now once the breakout happens, we expect the targets to be done in less than 1/3 the time. So consider if the chart pattern of the cup and handle is for 1 year, we would expect the targets to be done in less than 4 months. So this is the simple calculation which we look at it in terms of one, what is the time frame, what is the breakout, and what is the ideal time frame in which the target should get done. Now, few things to note in this pattern is when the breakout happens, if volumes are better, it is generally a good indication. Even if the volumes are not great, because the structure of the pattern has a much more higher success rate, you want to get in because the volumes could happen a few days later. Now out here, the more important part is, although the structure gives you a target price of say 160, what we've seen is many a times this could be start of a longer term uptrend, and this could surprise on the way upside. So the longer the pattern it is, more surprises on the upside is what we've noticed over a period of time. Now out here, the bigger part is whether you can ride on to this move. Now going into the variations, in this variations, one of the classical ones which you really want is that this breakout is generally also a multi-year high. And at times if it also coincides with an all-time high, that is the best case, because then you call it as a open territory because there are no resistances on the way up. So the ideal combination is a cup and handle formation with multi-year highs or with an all-time high. So this is what we call as a cup and handle. We'll see examples as we go forward. The next chart pattern is called as triangles. Now what are basically triangular patterns? When you call it as a triangle, it is basically a consolidation. Now what is happening in a triangle? You call it a symmetrical triangle like this, or you call it an ascending triangle like this, or you call it a descending triangle in like this. In all the three cases, what is happening? The range for the stock is compressing. So the earlier range could be 30 points, then it compresses to 20 points, then 10 points. So this is basically a consolidation. It's like a compressing a spring, which will eventually blow out on either side. So that is where we look at triangles. So it is basically a consolidation which will give you a breakout eventually. So the first part of this is when we call it as a symmetrical triangle, which basically implies a symmetrical triangle where on both the sides you have lower tops and out here higher bottoms. Now in this case, the breakout can be on either side. So it can break out also or it can break down also. the probability of both the cases is open. Now in this case, volumes become extremely important. So remember a few things which I say. In symmetrical triangles, volumes have a lot of importance. Then when you go to ascending triangle, what do you have? You have a flat top and you have higher bottoms. Now what we saw in Dow theory is higher tops and higher bottoms. So out here we have higher bottoms, but higher tops are not there. So ideally half the structure is present for an uptrend. So in this case, your probability of a breakout on the upside is higher compared to the downside. So in an ascending triangle, you want to play the upside breakout. Similarly, on the descending triangle, you are on the opposite side. You have lower tops and flat bottoms. In this case, your probability of the downside is greater because already the trend could be down. So in these three cases, you have to remember these three important parts. In symmetrical triangle, you have volumes to be very important because on the way of the breakout or breakdown, you want higher volumes. In terms of an ascending triangle, you have an upside which is higher probability compared to a downside. Similarly, in the descending triangle, you have the probability of the stock breaking down to be higher. Now, these are chart patterns, again very similar to what we look at all chart patterns. What is the time frame? So triangles are shorter term patterns because you can't expect stocks to consolidate for 5 years and get compressing in a range. So these are generally few months or few weeks. Very small triangle patterns could also happen, which could be maybe even 3 to 4 weeks, 2 weeks also. So these are shorter term time frame patterns, and more importantly, you have to understand that when you are looking at triangles, you have to look at volumes as a very important criteria. Even if you do not understand the triangle well, volumes could be your guiding light in these patterns. Now, when we look at the time frame, say out here also it is very similar. You expect your targets to be done in 1/3 of the time frame. So if the triangle pattern is for 3 months, your target time frame is 1 month. And secondly, you don't want to complicate it a lot, so I'll not go into further complications here. Now, the next pattern is channels, which is where, again, see, in all chart patterns, it will either be flat, ascending or descending. So a flat channel is very simple. It basically implies the stock or the index is range bound. So basically you have a range from say 100 to 150, the stock goes to 100, goes to 150, comes back to 100, goes to 150, comes back to 100, goes back to 150. So this is a nice sideways range which has been formed. So in this, the ideal trade is you want to buy the breakout or the breakdown. The other trade is after 2 bottoms and 2 tops are done, when the retest say it comes back to 100, you want to buy it for a bounce. So the ideal trade is the breakout trade. Same way, a channel, if you look at it, an ascending channel, it is again higher tops and higher bottoms. The difference between a momentum breakout or a momentum trend with an ascending channel is it is generally a little slower in terms of momentum. So an ascending channel is a slower uptrend compared to that normal breakout, which is basically 3 steps up, 1 step down, 3 steps up, then could be 5 steps up. So it's a ladder, and out here it's a channel. It's a slow sloping one. So ascending channels are classical uptrends, slow and steady uptrends. So in this, the breakdown would imply a short-term top in place and a short-term correction. Same way for a descending channel, it's the opposite. It's a downtrend. A breakout would imply a short-term bounce. It may not necessarily change trends. So channels are to be looked as trading opportunities, and in a steady uptrend, you want to go with the trend as well. So out here, look at channels in terms of very simple perspectives. Sideways channels, you want to play breakouts. Ascending channels, you can buy the dip and sell the breakdown. Descending channels, sell the rise and buy the breakout. So now continuing, the last pattern, which is much more shorter term in nature, is called flags and pennants. Now basically, like we said, ascending channels are slow and steady sloping ones. But there are momentum times where, like I said, you take 3 steps up, 1 step down, and then again 3 steps up. So this type of patterns are generally flag patterns, which is where there is a strong uptrend. So you see a stock go from 100 to 130, then consolidate in the range of 130 to 122, a very tight range for a few sessions. Now flags could be roughly 2 to 3 weeks maximum. It could be 5 sessions also. So these are extremely short-term patterns. You don't expect a flag to be 3 months or 4 months or 6 months. These are ideally weeks and days. So, and it's a very shorter term range. So out in this, it is very simple. You have a first big move followed by a consolidation, which is a very short range. Your targets in this case is, the first target is the size of the flag, which in this case, if you take, say it's a flag from 122 to 130, your first target is 8 points. So you're looking at 138 as your first target. Then say the pole size is from 100 to 130. So your target, the next target is 30 points. So it goes from 130 to 160. So in this case, what you're looking at is you're playing momentum. So out here, the trend is already set. So what implies in a flag is, because there has been a pole, the trend is already set in a big way. And then every time there is a fresh move, you're playing that trend. And this has to be extremely shorter term in nature, because overall the pattern is also shorter term in nature. Now the flags could be different shape, that's why we call it pennants. It will not be an exact rectangular flag, at times it could be triangular, it could be like we say a P flag, etc. So a pennant is something like a P, you will look at it, or a very small pattern. But the whole point is, out here the trend has to be set, so you are playing more on the upside. On the downside is also very similar, but what we've seen in, there are lesser downside flags relatively compared to the upside. The reason being, because falls are much more sharper, lesser consolidations. The up move takes this step by step moves in a trending market. So to sum it up, we've looked at these patterns. Which are the patterns we've not looked at? We've not looked at a head and shoulders, which is a complicated pattern. Plus it has a lot lesser hit ratios, plus a lot of confusion in catching them. And inverted head and shoulders would imply actually to be a cup and handle. And there are various other patterns, some of them which are much more complicated. But what we've seen is, these 3-4 patterns are enough, because they cover 70 to 80% of the possible trade scenarios you would have. Now, so starting off, a summary of them. Cup and handles are a little longer term in nature. You can actually get longer term investments also out of a cup and handle, because if it's a 3-year cup and handle pattern, you see a breakout. Let me give you a very simple example to cup and handle, because we've been talking here. We've looked at Nifty over the years, right? So it used to be 6,300 in 2008, 6,300 in 2010, then 6,300 in 2014. So this was a classical cup and handle formation which broke out in 2014. Similarly, we saw 9,000, followed by 7,000, back to 8,900, then breaking out 9,000, another classical cup and handle formation. So this is the way we look at cup and handles. The next one we looked at is triangles. Now triangles are something which can be short term, and in this you have to remember volumes have a much more importance. Then we look at channels, which are to understand it's a slow and steady uptrend. And finally, we look at flags, which is where you try to catch momentum, which is where the trend is already set and you are looking at a continuation of the trend. So these patterns are which we'll see across a lot of small caps. These patterns are best understood by examples. So what we'll do is, we've taken a brief on the chart patterns, but we'll take a much longer duration videos on a lot of examples in the next video.